Yes, it is time once again for the global markets technical outlook, this time for the end of quarter one of 2026. Just reiterate the disclaimer that Robert said nothing is a recommendation to buy or sell any financial instrument. Do your own homework. Don't listen to me. I've got no idea. So, if you haven't heard one of these before, we basically just take a wander through the global markets, in particular the US stock market. We'll have a look at some of the US market internals. We'll touch on a bit of cycle work. Then we'll roll through into the Australian stock market and round off on currencies and commodities. And if you've been hiding under a rock, you will not know that it has been a fairly volatile time in the market. But the true investor welcomes volatility, says Warren Buffett. A wildly fluctuating market means that irrationally low prices will be periodically be attached to solid businesses. Always worth keeping in mind as we dive straight into the US stock market. And you wouldn't have thought that it's been that volatile when you look at this chart, because this is the long-term monthly log chart, and it's still in that very well-behaved uptrend that it's been in since 2009. Nothing has changed. And if you look at the sell-off that we've had and the recovery and the with the Iran ceasefire, it's nothing compared to some of the larger corrections that we've seen in the past. What does that mean? Well, does it mean perhaps there's a bit more work to be done here, or does it mean it's all over and we're off to the races again? And that's the question that we'll hope to answer in the next little while. If we dig a bit deeper into the weekly chart, we can see that sell-off that we've had recently, and then the recovery, the strong recovery, if you like, of those two big green bars there. What interests me is the pattern, though. You'll see in this previous correction here back at the start of 2025. This was, of course, the Liberation Day sell-off. That we came right back and tagged to the previous level of resistance, which then became support to to project the market forward, and off it went. For a sustained rally. We haven't done that this time. We haven't come back and tagged the previous level of resistance. And so we haven't had that washout that forces the weak hands to release their stock, which sucks in fresh buying and sends the market higher again. So I do wonder whether, this is just, like B if you're an Elliott wave person, and we get another wave C down to tag this area. Because it just seems like it's not really done enough work to then blast off and start making new highs again. But we shall see. On the Ichimoku chart, again, it's still confirmed bullish. We're still well above the cloud. The price and this green lagging line, or Chiku span to give it its correct name, are both well above the cloud. That indicates the market is still bullish. And once again, we didn't even get the tag of the cloud. Now you see back here, we got a tag of the cloud. And often when we get these big corrections, the market will find support inside the cloud before it takes off once again. So you can picture if we got a similar leg to that first leg lower, that would take us well inside the cloud, and perhaps that's where the demand will start showing up if we are to get another leg higher. I mean, we don't know what's going to happen after that, but I do wonder whether we need another leg lower before we get some sort of resolution of the next direction. So let's have a look at the market internals now and see if any of that is backed up by the evidence. This is the bullish percent index, the market breadth that measures the number of the percentage of stocks in the S&P 500 that are bullish at any one time. And the signs were there that before we got this latest correction, we had this type A divergence with the market moving higher, the market breadth deteriorating, and then finally we got that quick sell-off. But once again, if you look at these previous two corrections, we got those washout lows where the market breadth came right down into the low 20s, which is generally considered a very good buy signal. But this time we did not. We got it down into the mid 30s, but not right down into the here to this low 30s area. So once again, I wonder if just another leg to lower to some sort of capitulation would give us that washout low in the breadth, and that would clean everything up for us. We're seeing something similar in the stocks above their 200-day moving average across the NYSE. We see those two previous washout lows, both of which led to sustained market rallies, and we just haven't had that this time. It's bottomed out a little bit too early, you might say, and it's uh, when that happens, there's often more to come. You have a look back here, just in the start of New Year 2025, we got the sell-off. The breadth didn't come right down. There was another push higher, some double top, if you like, and then we got the washout low. So we do wonder whether there's something like that still to come. Having a look at some of the ratios now, the discretionaries versus the staples, and this has really just been going sideways. It was up, it was down, it was up again, and now it's back in the middle of the pattern. So not really giving us any directional information there on the discretionary versus staples. The semiconductors versus the S&P is still rocketing higher. No surprise there, I guess. I mean, AI is still the big theme that's in the market, despite the geopolitical mayhems that's been unfolding over the past few months and weeks. But AI is the thing that's really been driving this market. Well, for a couple of years now, really. But going back to this low last April, that was really when the market took off. And there's obviously still huge demand for chips and from the big AI companies and so on. That is obviously driving the price of semiconductor producer stocks higher, and that's what's resulting in this move up. Now, this is often a leading indicator of where the market's going to head, but at the moment there seems to be conflicting signals because we've got some things going sideways, some things going up, and other things going down. This is the home builders versus the S&P 500. And this is in a sustained decline, as you can see, since really the back end of 2024. And probably no surprises. We'll get onto in the cycles. We're kind of coming into the top of the 18-year real estate cycle, and often as part of that, we'll see home builder stocks start to fall, and this is before it leads into the impact on property prices themselves. So this is kind of expected for the times, but nevertheless, it's also a drag on the S&P itself. So. This is, as you can see from these last three charts, not everything is pointing in the same direction at the moment. The advanced decline line, however, is still looking quite bullish. We did get a little bit of a kink in it following that recent sell-off. It's reverted, of course, with the buying that we've had in the last day or two, but we'd really want to make that see this making a new high before we can imagine that the market's going to blast through that 7,000 area. We haven't really touched on that, but 7,000 is obviously a key level, being big psychological round number, and that's probably why it ran into some supply around that area. But I do wonder whether on the advanced decline, whether we're in a similar situation that we saw back here towards the end of 2024, where we got the sell off, the advanced decline wasn't able to make a new high, and then we got another leg lower, if you want to call it that, which coincided with the Liberation Day sell-off as well. So this will be one to watch, but overall, it's obviously still pointing in the right direction. On the relative performance, we've only got a few months in the year, but year to date, the S&P 500 and the Nasdaq 100 are both just down a little bit at 1% and change, really. But the Russell 2000, which is a small cap index, is actually doing very well. It's recovered up and is 6% higher. So in this latest recovery, it's really been the small caps that have been getting picked up. So we're seeing value investors, if you like, diving in and buying up the smaller cap assets. Meanwhile, the larger caps and the mega caps, the big AI companies and the Mag Seven and so on, they're not seeing the same level of recovery as the small caps. So that's interesting because that's kind of a flip the script from where we were last year, and we'll see how that plays out in the coming months. Over on the yield curve, we are in this kind of normal shape once again. And as you can see from these shadow lines, it hasn't really been moving around too much. It's maybe the whole line itself's maybe elevated up a little bit, but the overall shape of it hasn't really changed. So normally this is a good sign. It means that we're in a risk-on environment because the shape of this curve means that money will rotate into riskier assets like stocks. But the current shape of the curve is not always the full story. It's more about the journey of the yield curve and where it's been. And we can look at this chart here, which is the spread between the 10-year yield and the 3-month yield. And between sort of 2023 and 2025, this was negative, which meant that the value of the 3-month yield was higher than the 10-year yield. So you got that inversion in the yield curve. And often what happens is, well, it's almost without exception, really. Once the curve has been inverted and it reestablishes itself in a positive shape, uh, it's often the lead into a recession. And if you have a look at these gray bars here, these are the recession periods. And this chart here actually tracks the odds of recession, so the probability given to a recession in the next 12 months by the New York Fed. But what's interesting is that you can see that because it's 12 months leading indicator, when the probability of a recession falls almost back to zero is when the recession actually kicks in. And obviously, we only know we're in a recession by looking in the rearview mirror because we need the quarterly data to figure that out. So it wouldn't be a surprise if we see a similar pattern this side where this falls in the next few months and then we get the recession ensuing. And who knows, we might already be in the recession at the moment. But given that we're still in the period where a 71% probability of a recession in the next 12 months was forecast, then it's obviously much better than a coin toss that we're on the doorstep of a recession if there is going to be one. So make of that what you will. Switching now to the sentiment indicators, and the this is an interesting chart as well because the put call ratio is still in this so-called bullish extreme territory, and what this indicates is that the call buyers are still outnumbering the put buyers, probably by a factor of 1.5 or 1.6 to 1. Now, again, if we think back to the price chart of the S&P, what this indicates is that we probably haven't washed out all those weak hands. There's still people holding on to those bullish positions, calls being a very bullish position, obviously. And they're not relinquishing. They're not being forced to sell those calls because the market hasn't dropped significantly enough to have them liquidate their position under stress. So this indicator is not reverting back into the middle of the pattern, which is where it should be under normal circumstances, especially after a correction. If we look back, here's the Liberation Day correction here, where we got the when the market sold off, the sentiment indicator immediately reverted back into the middle of the chart, which is what we would expect. But we haven't had that this time, which again makes me think, and I don't want to labor the point too much, but it does make me think that perhaps we've got a little bit more to come on the downside. On the volatility index, well, we've now got another volatility episode in this time frame that we can add a label to. The Rand Taco trade. If you're not familiar with the ribbing that Trump gets online, Taco stands for Trump always chickens out, which he did at the very last minute, and probably should be commended for it this time because the alternative was not looking too appealing. But what's interesting to us is that despite the market having recovered, at least half of what it lost in the sell-off, this volatility has not fallen back to low levels, and that tells us that there is still an appetite for protection or a demand for protection around in the market at the moment. And none of the large protection holders, and these tend to be the institutional fund managers and so on, they're not willing to sell their insurance protection for their portfolio, and that's keeping the value of the VIX elevated. So it feels like we are entering a little bit more of a higher volatility period. If you look at these last two major spikes in the VIX, the Bank of Japan's interest rate announcement and the Liberation Day announcement, they both immediately were cast, they both immediately collapsed back down into the teens. We've not seen that here yet. And that's what makes this time look a little bit interesting, a little bit more interesting than previous typical corrective episodes. If we look at the VIX on a long-term basis, you can see that we are sitting just here, just under that elevated, or just inside that elevated risk section. We're obviously seeing nothing like the two big episodes that we had, which were the financial crisis and the COVID sell-off. But that's, if we got a larger, if just say the ceasefire doesn't hold, or there's some other unexpected geopolitical event, we could see it move very much higher from this area here. So I guess the shorthand is we're not out of the woods yet, it would seem. The CNN Fear and Greed Index. So the last time we ran this quarter ago, it was sitting at 36. It's now at 31, so it's barely changed. Their Fear and Greed Index looks at a number of different measures, including sentiment, including market breadth, and a number of other things. So perhaps the market breadth being at a lower point is feeding into this this indicator here. But perhaps, and also the VIX being still elevated as well. So there is still a little bit of fear around. And despite those big green bars that we're seeing on the price chart, things are maybe not as rosy as they seem. So with all that sort of conflicting information, I thought it might be a good time to bring back our periodic series of where to from here, because there's a couple of charts that have come across my radar, which I thought were very much worth sharing. First one is this, which is the 12-month rate of change of oil. When it goes above 100%, it's been a very good indicator of coming stock bear markets. So you can see the indicator down here. Predicted the forecast, the 87 crash, the 90 crash, the dot-com crash, the financial crisis, and the 2022 bear market as well. And look where it's sitting right now. It's back. Now, it's probably no surprise that, oil is a massive input to just about everything in the economy. And the stock market prices commerce in the economy. So if that's going to take a hit, then you would think that there would be a knock-on effect to the stock market itself. So it makes sense. Whether we'll see a similar outcome this time around, we'll have to wait and see. But I just thought that was interesting because it's an infrequent indicator. So one to watch. And the other thing to keep in mind about the stock market itself is it's massively overvalued at the moment. The forward PE ratio of the S&P 500 is sitting up about 22 at the moment. And this chart here looks at the forward PE ratio versus the forward-looking returns for the next 10 years. And as you can see, it's very highly correlated. I mean, the R squared on that is probably, 0.9 plus. So, in other words, it's a very reliable indicator. And with a forward P ratio of about 22 means that the future returns for the S&P 500 over the next 10 years are between 0 and -2, let's call it. So if you're a long-term holder of S&P 500 ETFs, you can probably expect that you're going to have fairly anemic returns over the coming 10 years. And then lastly, just looking a little bit more short term, I thought that there was a couple of patterns that jumped up, which I thought were interesting, which is the type of recovery that we've had from this correction. So if you look at the pattern, coming into the top here, we've got these very small bars, low volatility, rise, which is what you'd expect from a bear market. Nobody wants to pay much more than the last guy. Then we get the sell off, but then we get these punchy green bars, which are much more reminiscent of, some sort of topping pattern rather than a normal correction. If we compare it back here when we got sell-offs, the recovery was much the same level of volatility, but here we're getting these punchy big green bars. There was another one here where we got low volatility move up, and then these punchy green bars following the correction, and it led to another rollover not much long after that. And I don't want to be a harbinger of doom, but if we look at 2007, where there was a very similar pattern where we got this low volatility rise, a correction, and then these punchy green bars led into a double top, and then of course we got the financial crisis after that. Now, I'm certainly not saying that this is what we're going to get. In fact, it's almost certainly not what we're going to get, because every bear market has a completely different signature. And so this one will, if there is to be a bear market, it will unfold completely differently to all the others. So there's no way of knowing whether it will be like 2001, 2008, 2022, or 2020. They're all very different in signatures, and the same will happen this time. But if you ignore the right hand side of this chart for now, and just look at this section here, I do wonder whether after these punchy greens bars we get a little bit more corrective action, and that would sort of reset the market, if you like, and then maybe we go higher from there. Who knows? On to the cycles, and as I alluded to before, the we are at the peak year of the 18-year real estate cycle. And if you look at the year just above that was 2008, which is kind of interesting, isn't it? And we know from our memory glands what happened after that. And if you're as old as I am, you'll also remember back to the recession of 1990, 1991 as well. So this is a reasonably reliable indicator of, certainly coming downturns in the property market, but obviously, they also usually coincide with bear markets or recessions themselves. So, one to watch. On to the annual seasonality for the S&P 500, and you can see it's generally on the cycle. It is a choppy start to the year. The first 3 months of the year can be quite choppy. They certainly have been this time, but of course we got this massive dump as we have done just in the last couple of weeks, and then the recovery. And there's nothing really on the chart, on the cycle chart for that. So I guess the only thing that we can take away from this is that coming out of this, April into May tend to be the most bullish time, apart from the back end of the year. So we're coming into a much more bullish period compared to the one we've just been in, which tends to have about the worst set of returns for any quarter. April tends to be quite strong, and then we get into the sort of sell in May and go away as the market sort of goes into the northern summer doldrums. So we'll see if April is able to stand up this time and make a recovery. But it's certainly a seasonally bullish tailwind for the market should it decide to take advantage of it. We are, of course, in the midterm election year, which is moving in towards these midterm elections in the US, towards the last quarter of this year. And you can see it's a very choppy looking picture on the cycle, heading into a high around about April, and then a sell-off down towards the elections themselves. Was this the high back in February here? Was that what we're seeing here, just coming a little bit early? Or is there more to come? Perhaps we get another high into April, May, and then we get much more of a sell-off into the election. So it's obviously early days, so we can't really say much more about that one until we get more data. On the decade cycle, we're into year six, of course, and we can see here that year six tends to be a little bit more choppy than the rest of the years, a little bit more sideways than the rest of the years as well. We've obviously had that great run up through 2025 as well, so it wouldn't be a surprise if we just had a little bit more consolidation through this year. Over now to the Australian stock market. And the ASX 200 on a monthly basis, of course, still looking very bullish at, all the way back here of 2009. It's, yes, it's had corrections along the way, but it's higher highs and higher lows. There's no doubt about that. It's just ran into a little bit of traffic up here at the 9,000 level. It has had a couple of attempts and it hasn't been able to get through it. If we zoom into the weekly chart, we can see that a little bit clearer. We got that sell-off back in the tail end of last year, and then another push to all-time new highs. And then, of course, the Iran sell-off down to here, but then the recovery as well. But 9,000 is obviously a very, very key level for this market, and you would really want it to spend a month or two above it to actually be satisfied that it's going to make it any further. Of course, if we get more sell-off in the US, then we are probably looking at a move back towards the 76 level, which was the 7,600, I should say, level, which was the last major level of support in this market. But on the Ichimoku chart, the index did come back and tag the cloud this time. You can see it came right back into that cloud support between about 8,100 and 8,700, and it found buyers, which is no surprise. Same thing happened back here. Came into the cloud, found buyers. I mean, these charts are definitely one to watch. I don't know if you can actually trade off them, but they're well worth keeping on your radar to see where the market is sitting. But of course, with the Chiku span and the price both above the cloud, then we can label this market bullish, and it remains bullish until both of those things break below this red line down here. And if we did head back to the 7,600 level, that would obviously happen. But it is worth noting that you do tend to get price crosses when the cloud gets narrow rather than when it's thick. When it's thick, it seems to provide a little bit more support and resistance. So. Looking at the ASX 200 and its peer indexes. So the ASX itself is up about 2% for the year. So not too shabby. Only beaten in this set by the Nikkei at 11%, so doing very well for the year. And then below that, we got the Hang Seng at break even, the S&P down about 1%, as we know, and then the Nifty, the Indian Nifty, down about 8%. So it's really getting hammered. Big importer of oil, obviously India as well. So I wonder if that's having some effect on them. On to the currencies and the US dollar index. And of course, despite all the gyrations that we've seen in the stock market, the US dollar index is actually holding up very well. Even despite the commodities moves, which we'll get into in a minute, the US dollar index has remained relatively sanguine. On a technical basis, it broke back through this 100 level, but it's found support around about 96, and it's just been consolidating in that area. It's managed to find buyers three times. This is on a monthly basis, remember. It's managed to find buyers three times at that 96 level, and it's actually looks like it's tapping on the door of that 100 level once again. I wouldn't be surprised if we see it move higher. The with the economic turmoil that this conflict has got us embroiled in, that's going to feed through to inflation and higher interest rates as well, and that will be good for the US dollar. And so, again, it wouldn't be a surprise if we see it back up into this pattern between 100 and 110. The Australian dollar has actually been having a very nice run, largely thanks to a little bit weakness in the US dollar, but also thanks to the price of gold, which is correlated with, and it's been making a little bit hay. You can see how it bounced off that 60 cent level. Again, that was the Liberation Day tariff low, and it's basically moved steadily higher since then. Had a quite a big kick up towards the back half of this year, especially when we got the surprise rate hikes by the RBA, which has pushed the Australian dollar much higher. On a technical basis, it's obviously running into a bit of supply around about that 70 cents area. And you would really want to see it, about two or three sustained closes above that level to have any confidence that it's going to move higher. If it fails here, then I think the next best guess would be a move back towards the mid 60s where we've got all this congestion around here. So it's kind of it's on the wire at the moment, and it probably depend on what the US dollar does as to what the Aussie dollar does next. We're seeing a very similar pattern in the euro as well. We got that move up, and now it's just consolidating at this sort of 116 level here. But kind of is very much sideways, stuck between 105, 105 and 125 for the long term. Well, last 10 years, really. It's gone basically nowhere. You would probably just have to give the nod to the bulls as it came into the pattern from below. So more often than not, it would move higher from there. But 125 will be a key level for the euro. The British pound also sideways. It's going nowhere fast, just sitting about 133 and stuck between that 120 and that 145 level. The Japanese yen is in all sorts, though. Yeah, it's been in this sustained downtrend, and it's found support briefly at that 0.0062 level, bounced high, had a double top, and it's now retreating back to that 0.0062 level. And if this is a key level and goes way back to the 90s as well, where it's also a support level. And if it breaks, that would be highly significant for the Japanese yen. On Bitcoin, well, I guess we can probably say we're officially in a Bitcoin bear now. Last time we had one of these discussions, it was sitting in this pattern here. Looked like it might recover and tag the underside of 109, but it wasn't to be. And I thought that 74 would be the next stopping point, but it's actually sliced straight through that and then bounced back and found resistance in the underside of the 74,000 level. So it's not looking great for Bitcoin at the moment. It's obviously a risk asset, and it's being sold off, and as the money piles into traditional safe havens like gold. In a technical basis, I think 52 would have to come into play if these lows are broken. Otherwise, if it can recover above 74,000, then it might just need a bit of time to consolidate, because this has obviously been quite a sharp and quick move lower. And riding off on the commodities, which are normally quiet, but these are the ones that have really been the movers and shakers of the last quarter. Gold, again, one of the last time we ran this presentation last quarter, it was sitting down here in the high 50s, and I was wondering whether we were heading into some sort of oil bear market. Don't forget, there is an oversupply, or there was an oversupply of oil before the Straits of Hormuz were closed. But the as you can see, the effect of this conflict has really sort of spiked the price of oil. And despite the ceasefire, we've got oil back to 97 from 120 where it spiked to, but still by no means back down to the levels we would expect if the strait is really open and fully operational. It's obviously going to take a long time to clear the backlog, and that's going to take a long time to feed into lower prices overall. Not to mention knock-on effects of things that are produced from oil, like fertilizers and plastics and so on. So I think we could be entering a higher price economy for quite a while to come, because this doesn't seem like it's ready to collapse anytime soon. Copper itself is doing very well. It's been shooting up in price ever since it sort of made a sustained break of this 465 level. It spiked up to past about $6.50, but it's just come back and consolidated. But bullish overall for copper. And that sort of tallies with the other metals, the precious metals in particular, which for silver and gold, I've had to put them on a log scale now because the arithmetic chart's just starting to look ridiculous. This actually shows quite a nice that kind of rounding pattern that we got. I mean, it's a long-term pattern. It took what 15 years to develop. You certainly wouldn't be holding it through that period, but when it took off, it really did take off, and it's now it's come back a little bit just in this little while with the de-risking that's been going on globally, but by no means anywhere close to coming back to that breakout era at 50. So still looking fairly bullish for silver. And the big kahuna, of course, is gold, which is also still looking very bullish. Went through this 2000 level, and it's barely caught a breath since then. Just starting to see it looking a little bit more volatile. Those bars are, and again, don't forget this is a log chart. So large bars on a log chart at the top mean very big moves. But we got that spike, and then the red candle. And obviously, the last candle there is just a very short part of the month. So you do wonder whether it's had a good run, whether we see it coming back a little bit. And as I alluded to, the direction of the Aussie dollar will also depend on what gold does next as well. So keep an eye on this on your radar too. So, just to summarize all of that, we've got the US stock market still nominally bullish. Of course, it's definitely bullish on a long-term basis, but we are entering a bit more of a sort of elevated volatility period, I feel, and I just wonder whether there's a little bit more corrective work to be done before we get the next move, either up through that 7,000 level or a bit more consolidation or even a deeper sell-off. Who knows? If these property cycles come to pass. So we're definitely entering a little bit more of a volatile period, both in outlook and in terms of the movements in the markets themselves. The Aussie 200 definitely bullish, ran into that supply up at 9,000. So it probably all hangs on what the US market does next. I would suggest probably it consolidates under 9,000. Absent of a large sell-off in the US, which would see it probably pull back towards that 7,600 level. On the currencies, we've got the US dollar just consolidating that little area between 96 and 100 on the index. And we're seeing strong Aussie dollar, strong euro, and obviously Bitcoin in that large sell-off stroke bear market that it's in at the moment. On the commodities, oil spiking, no surprise there, of course, and the metals, particularly copper and the precious metals, still looking relatively strong. With that, I will thank you very much for your time. Wish you good luck, good trading for the next quarter. Thank you very much.